India's stock market is booming. India's famous Nifty 50, which is a key indicator of the Indian stock market, comprising a weighted average of the 50 most prominent Indian companies listed on the National Stock Exchange, has reached extraordinary figures. As of the latest data, the index now has over 22,000 points. That is a huge increase from just 12,000 points from 2020, which was just a few years ago. This has made so many people across India rich. From individual investors to hedge fund managers and owners of the company experience an increase in their net wealth. Take a look at some of the country's largest companies and their market capitalization. Reliance Industries, India's largest company by market capitalization, grew from $130 billion in 2019 to over $236 billion by 2024. Tata Consultancy Services for the same time period grew from $100 billion to $170 billion. Even the list of Adani companies experienced booming growth, which may have truly caught the eyes of short sellers. Adani Green Energy grew from just $4 billion to over $35 billion. Adani Enterprises grew from $3.5 billion to over $42 billion. What's surprising, however, is that while India's stock market is booming, its neighbor and arguably its economic competitor is falling. China's stock market has been sitting in bear market territory for months now. The difference between the two showcases the economic situation. India has been reporting stunning growth rates year after year, quarter after quarter, whereas China's economy has plunged into a real estate collapse, deflation, and stagnation growth, factors that are significantly impacting its stock market. India's rise comes at a time when investors are looking for stable and profitable opportunities amidst global uncertainties. The Indian government's reforms aimed at improving ease of doing business, attracting foreign investments, and developing key sectors such as technology and manufacturing have played a pivotal role in fueling this growth. But is that really all to it? Is India's stock market boom really due to its economy and the government's push for a better future? Well, one of the most important factors to understand whether it really is due to the country's economy or some other factors to the concept of price to earnings ratio, or P/E for short. The PE is an indicator that helps investors evaluate the relative value of a company's shares. Essentially, it measures the price of a stock in relation to its earnings per share. A high PE ratio can indicate that investors are expecting higher earnings growth in the future as compared to companies with a lower PE ratio. In the context of India's stock market, analyzing the PE ratios of major Indian companies can provide insights into whether the stock market boom is justified by the actual performance and expected future earnings of the companies. If the PE ratios are excessively high compared to historical averages, it might suggest that the market is overvalued, potentially driven by speculative investments rather than solid economic fundamentals. According to several resources, the PE of Nifty 50 stands at about 22.7 for the latest dataset. That is actually not that high. Just take a look at some previous data. Back during COVID-19, it rose to over 42. Periods of 2008, 2011, and 2015 saw a similar PE ratio of 20. That just means historically, the current PE ratio of the Nifty 50 index is not exceptionally high compared to some of the previous market phases. The force that is then helping push the Indian stock market to record levels lies in some other reason, and that reason can be attributed to India's economy and companies which are now reporting higher revenues and profits. Just take a look at Reliance Industries, which has a PE ratio of 28. Its net income rose from $8.3 billion in 2019 to over $12.22 billion by 2023. HDFC Bank, India's largest bank by market capitalization, saw its PE ratio fall from 37 in 2019 to just 18.7 for 2023. Its earnings likewise grew from $5.2 billion in 2019 to over $9.24 billion by 2023. The only company that saw an unusual growth in PE is Adani. Just take a look at Adani Enterprises, which saw its PE ratio to over 141 from just 13 from early 2020. It even reached nearly 317 at one point in 2022. This shows why many are wary about Adani's companies, to suggest that they are overvalued and possibly at a price that shouldn't be there. Now, let's understand what a higher stock market means for India. The boom in India's stock market will impact the economy through various channels. Firstly, a thriving stock market signals robust business confidence. When stock prices rise, it usually reflects investor optimism about the health of the economy and the profitability of listed companies. Higher share prices can boost consumer and business confidence, leading to increased spending and investment. This, in turn, can stimulate economic growth. Secondly, a higher stock market enhances the wealth effect. As the value of stocks increase, so does the wealth of individuals who own them. This can lead to increased consumer spending as people feel wealthier and more financially secure. This spending fuels economic growth and can lead to the creation of more jobs. Thirdly, a buoyant stock market can help companies raise capital more efficiently. When the market is doing well, companies can issue new stock at higher prices, which means they can raise more capital for expansion research and development and other investments. This can accelerate corporate growth and, by extension, economic development. Moreover, a strong stock market can also attract foreign investment. Foreign investors are more likely to invest in a country's stock market if it is performing well, which can bring additional capital into the economy. This foreign investment can help to strengthen the currency, reduce the cost of capital, and create more employment opportunities. However, it's important to note that a rising stock market does not benefit everyone equally. The wealth effect predominantly impacts those who own stock, which, in many countries, represents a smaller portion of the population. Therefore, the benefits may not be as widespread across all economic sectors and demographic groups. But anyway, do let us know what you think down in the comment section below. Thanks for watching.